Hello guys, in this video I got question from someone who is investing, and he wants to understand what's the difference if you buy, for example, a mutual fund or you buy an ETF. ETF, it's an exchange traded fund. What's the difference between them if I want to invest in the future? Okay. Now, a mutual fund is a collection of stocks that the manager has selected. Now, if you go to this mutual fund, the name by name, you go online, you click on it, you will see the stocks that he is in. Okay? But you find, for example, 15 stocks, 20 stocks, or 30 stocks, depending on the mutual fund. It's just, and these stocks, they are not from the same sector or the same industry. They are like mixed. They sometimes put even bonds. They put a lot of stuff. It means this guy who is a manager, he wants to manage and to try not to have risky investment. To have, I'm not saying safe, but safer. It means he buys from here, he buys from there, he buys from there. He try to diversify, as they say. Now, when you diversify, your growth will, it means the performance will be less. And because there are a lot of different industries, a lot of sectors. So, for example, mutual fund, he buy Facebook, which is from internet stocks. Then he buy Walmart, which is retail. Then he go to Johnson & Johnson, which is a drug company. Like this. It means he wants to diversify. Now, the fees are higher than the ETF. I will explain the ETF, what is it. So, mutual fund, first we have a manager who manages the stocks. He sells and he buys according to what he knows. So each manager is free, or they have some regulations. Okay, but he by himself chooses, okay, the stocks by himself. Now, this mutual fund take fees. You can see the fees in the mutual fund, which is very easy. Don't be mistaken. You should go, for example, if you have 401k, go to it. Or if you don't know where it is, or what's the broker that it is in your 401k, ask your human resources man or woman, and she will tell you, to give you the website. You enter and you see your investments. I know 99.99 that thousands or millions of people here in America, they have 401k, they have never seen where the money is invested, because the company invests for them and they put wherever they like. If you are serious about what you are doing in your life, you should go and see. Maybe the company, your company, put your 401k into a mutual fund that it is a loser. It is losing a lot of money each year, and still they put always, when they cut some money from your paycheck, they throw it in that bad investment. That's why you should, at least, I'm not saying to be intelligent or to be high Q as the other people, but just to check where your money is going. Okay? Now, speaking about ETF, it is called Exchange Traded Fund. Now, what does it mean? ETF, it is just like a stock. You can buy it, you can sell it each day like a stock. And it tracks an investment. Okay? Let's say you want to track the Dow Jones 30 stocks, industrial 30 stocks. You want just to track them. You like the index, which is Dow Jones, you like it, you see that it is going up, and you say, okay, how can I buy this index? You just go and search for the ETF, and you find it in the ETF. It's called, it's having this symbol DJIA. You go to it and you find that it is the ETF tracking. It does what the index do. It has a price, let's say 120 or $60 or wherever. Okay, the indexes are different. Now, since it is an automatic track of an investment, the fees are lower. I think it could be 0.5 out of 100. Okay, sometimes it is less, sometimes it is up, so it is lower fees. Now, some people who are looking for industries and they see the rotation, as I explained in my training level 3, how to search for stocks using an index industry. You can take that training. It will help you search for indexes or indices that you think is going up according to my criteria, and then you just buy the ETF. It's like a stock, but what you are buying, really, you are buying the index. It means you track the index, and the fees are less because you can't buy an index. For example, let's say you go to an index, to an industry, biotechnology, for example. You will find hundreds of companies. You by yourself, you can't buy 100 shares for each company and you make an index by yourself. It's really hard for you because you don't have money. Okay, so what you should do, you buy just the ETF that tracks the index, as if you have bought the whole index stocks. Some people they like this. Now, people they like ETFs because we have less fees. Now, if you go to mutual fund, you pay more fees. The fees are hidden. It means inside. It means they are taken. They are already taken. When you see the price, it's inside. So it is taken. That's why you see that mutual funds are slower. If an ETF, let's say an industry is going up so good, it goes 20%, 30%, 50%, and you are in, you will be making a lot of money compared to mutual funds. This is why the people, they like ETFs and they don't like mutual funds. And if this ETFs or mutual fund, they are the same. If they are giving dividend because they have dividend stocks, they will give you this dividend. If you don't know, you should ask. Okay, you call them or you ask. Now, for ETFs, they are easier because it's like a stock. You find the ticker, for example, the Dow Jones Industrial 30 stocks, or the blue chips as they call them. It's the symbol is DJIA. You find it, you put it in the chart, you will find, and then you just buy it. Next, let's say tomorrow you buy it. If it's going up and you think you will make money, you buy it as if you have bought 30 stocks. Okay? This is the difference between them. And whatever you choose, it is your choice. But before you do anything, you should calculate things. Try to see, if you want to buy a mutual fund, please go to the mutual fund, see what is inside, what are the stocks that are inside. If you want to buy an ETF, try to see what kind of ETF is this. For example, let's say you want to follow gold. Let's say you are interested in gold, silver, precious metals. What do? You go, for example, the ETF for gold is GLD. This is gold index for the ETF. If you see that gold is going up, you buy this ETF without buying physical gold. It means you don't buy bars of gold and you put them in the bank, and there are fees, and you know, when you want to sell them, it's very hard to sell them. There is a problems with when you buy precious metals in physical. But in the stock market, it's very easy. You can buy whatever you want, and you can sell it the day that you decide to sell. You sell it very easily. There is no problem. That's why I like more stock market than any other investment. They are the same investment, but physical gold, physical silver, they have problems in putting them in the bank, in selling them for the future. They can give you a bad price, and you can't make it. Okay, so thank you very much for watching this video. If you have questions, you ask. If you want a private message, please send me a private message. My email is here on the top of the description. Just send me an email. Thank you very much, and have a nice day.